Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets that, how can they make any sense? Of course, bonds are down today, so we know they don't make any sense. I'm your host, Steve Van Metre, and thanks for joining me today. And today we're going to figure out why banks want lower interest rates. We're going to talk about the Fed meeting. We're going to go over the credit data. It's my favorite day for macro is the H.8. Tells us so many interesting things. Now, before we get into all of that, something that you have been patiently waiting for, it is out. I just posted it on Twitter. It is the inflation fairy tale. Why it's deflation we should worry about. The fabled Jeff Snider interview. Now, there's some problems. It only has 21,000 views. And my interview with Brent has 281. So we need to get at least a 2 under here. So Jeff feels really cool because he is, and we want to get him back. I'll post that in the description. And he is just a superstar. Many of you know that. Now, a Real Vision exclusive. I did a 50-minute follow-up on that interview, going through the questions with Jeff. Only available on Real Vision, only on the exchange. So that will not be made public. All right, now I want to say I'm really impressed how many of you handled Wednesday's episode, or was it, the one where I said Biden, stocks love Biden. And isn't it funny that, stocks love Trump, and they all said, no, maybe they like Biden. Look, it's the market that makes the news. It's not the news makes, it's the market. So the news is trying to go through and figure out, well, why are stocks up? Why are stocks up? Is it stimulus? Is it maybe Biden won? Is it this? And I gave you the answers. And like I said, I was really impressed because I thought the comments were going to be like walking through a firestorm of politics. And it wasn't that bad. But the key is, a lot of money managers are not protecting their portfolio, and a lot of investors aren't protecting their portfolio. So think of it like driving around without car insurance now. It's a law, so you have to do that. But in the investing world, there's no rule that says you have to, have some portfolio insurance. So going into the election, what did we see? Volatility rose and the dollar rose. And why is that? Because money managers were starting to take on some portfolio insurance. Then as the night of the election, apparently whatever concerns, or maybe they didn't have any, they were just thinking, I better buy some so I don't look like a complete fool if things go the wrong way. That is a good reason sometimes to buy portfolio insurance when you want to tell your clients, oh yeah, by the way, we drove your investments off a cliff and we didn't insure that. Yeah, not a conversation you want to have with people. And so what happened in the days following, obviously markets did not do anything crazy, and the insurance came off. So again, we see volatility drop, we see the dollar drop, and when those happen together, where's my stock arrow? Boom! Yeah, it's like literally pouring gasoline into the equity market. I mean, boom, 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 stocks go up. So I'm glad most of you got that. Let's talk about the Fed meeting. So that was a complete nothing burger, right? I mean, some people thought, they're going to do more QE. They're going to do this. They're going to do that. The reality is they weren't going to do more QE. Now, why weren't they? Well, because Fed Chair Powell already has advance notice of today's Nonfarm payroll report. And when we look at it, we know it is the most faked data. And it is not that accurate as a result of being faked, because it gets revised over the next 3 months. And then usually somewhere around, 18 months later, they come back and, clean up the mess from that. The market loves it. The Fed follows it. And so even though the numbers were slowing down, it will take us, I think David Rosenberg said, at least another year if we continue at the current numbers to get somewhere back to where we need to be. Powell looks at these numbers, sees a relatively weak dollar over the last 5 years, not going back much further than that, but over the last 5 years, the dollar's at the lower end of its trend. You got strong payrolls, the market's up. He's not going to go and do more QE. There's no reason for him to do it. Now, what he did do, what is more important, and what we should care about, at least as the bond king, what's the one thing that I really care about? Is it all this credit data? That's cool. Is it that there's a lot of unemployment? Well, that's usually good for bonds, but I don't want people to be out of work. Is it the banks tighten lending standards? It's a bonus. It's like getting whipped cream on a Sunday. It's delicious, but it's not required. what is it that I really want to see? More QE. I want to not, and if I don't get more, I just wanted to see that they continue doing QE. And Powell made it very, very clear, as he has in his prior meetings, that we will continue quantitative easing at the current pace, and we are willing to do more if we need to. Now, I suspect in the next couple of months they will need to, but at the moment, they're static, and that's okay. So Powell and his merry band of rats went on their way, and I didn't bother wearing my sorcerer hat because I forgot it. Okay, so let's move on to the economic data. There's some interesting stuff in here that we want to look at, and no, he is not one of them. The Challenger job cuts slowed down to 80,000 announcements with a year-over-year rate of 80.7% increase. What are Challenger job cuts? These are going to be your larger corporations announcing cuts. So they announce them in advance. Moving on to the jobless claims numbers on Thursday. Now, where I really like to look, and it took me a while to find where this was on the Department of Labor website, is they've got the whole picture here. So initial claims dropped 7,000, which is pretty good. I mean, a drop right now is good, but we're still running 751,000 claims. And this is going to be a problem going forward now. I remember a lot of people thought there was going to be a second stimulus before the end of the year. Businesses could hold on. They knew if they know people are getting money and they're going to spend it. Now they're not. So one big question that is coming up from a macro space over the next several weeks and months is, our employers going to start laying off again because there's no lack of demand? Remember, people that are on unemployment have less income. So that is important to understand. If we kind of move through here, we notice that pandemic unemployment assistance claims rose a bit. So what happens is when you run out of state, you go over to the federal system. But here's the bottom line is, last week, there was 22.661 million Americans receiving some form of unemployment assistance. That dropped by 1.152 million to 21.508 million claims. That's a lot of Americans out of work. That is not inflationary, simply from the standpoint of they're getting less income. They still have to pay their debt. So if you do the math, right, I have debt, I have less income. What does that equal? Less discretionary spending. That's really the key. Where do we get, demand and inflation from? Discretionary spending. So, of course, borrowing money to do that. Well, guess what people that are on unemployment can't do? Borrow money. All right, let's go back to the data here and move into Thursday evening, where Japan reported data. And Japan is got to be, if they're not, I don't know if they're officially in a recession, but they ought to be, because household spending is down 10.2% from last year. Overtime pay is down 12%. Whatever's going on in Japan, which will get its way across the pond and infect the rest of the global economy, is not good news. You don't want to see this out in Japan. Moving into the Friday data, we'll zip all the way down to the Nonfarm payroll report. Came in above expectations at 683,000 jobs created. This puts the Fed on hold of their current plan, so they're going to continue the quantitative easing at its current pace, but nothing more than that. The participation rate, so the percentage of people participating in the labor market, increased slightly to 61.7%. But this is huge. The unemployment rate dropped to 6.9%. So again, Powell doesn't have the latitude to really do anything at this point, anything more than he's doing now. Looking at average weekly hours worked, they were flat at 34.8. And average hourly earnings slowed slightly to 4.5%. The monthly earnings, a little under expectations at 0.1%. Overall, this is a solid report. I mean, this is a great. Assuming that it's all true, this is actually a really solid payroll report. Let's take a look at the labor force participation rate. So again, everybody's calling for higher interest rates. They can only go up. There's only one possible way. And if you look at the labor force participation rate, and I've overlaid 10-year treasury yields, you see that we're well below where we were prior to the pandemic. So the labor force participation rate was running somewhere in 63 to high 62 to mid 63%. Today, it's at what, 60, what do we say, 61.7, I believe. The bond market is pretty much telling you that's not inflationary, and that trend is not likely to continue. It's not likely to continue accelerating higher. It's more likely to slow down and roll over. And you can see the momentum or the look of this, and I'm sorry, I'll make it bigger for those of you on your cell phones. You can see it doesn't have a lot of momentum here. It's stalling out. And that was, something we looked at the other, I think in Wednesday's video, when we looked at the import and export, total dollar amount. What did I tell you? The momentum was slowing. You saw it in the graph. Well, if imports and exports are slowing and likely to roll over, well, guess what? You don't need a lot of workers. So this is not really a good sign. Even though their payroll report was good, it's kind of telling us that perhaps the next payroll report isn't going to be as great. And that is obviously going to be a problem for the markets as we go into the winter months, which are generally slower. And with case counts rising, that puts a lot at risk that holidays and travel and all the things that that move money around are going to slow down. So a lot of risk in that. All right, let's move on to the assets and liabilities of all commercial banks. First thing I can get to at 1:15 p.m. Pacific is when this is released. And it's very interesting. So the first thing I look at is bank credit. And what do we see? Bank credit expanded. Now that is usually a good sign. Now what does that mean? That means the banks are getting bigger. That's what you want. Now the question then becomes is, how did they get bigger? Well, that's where the data doesn't look that good. So if we come down to Treasury and agency securities, or securities and bank credit, which is made up of mortgage-backed and U.S. Treasury securities, what we find out is that increased by $34 billion. But keep in mind, the bank credit only expanded by 10. Well, what is that telling us immediately? That loans decreased by $24 billion. And that's how you get the two to the bank credit. You've got the securities and bank credit and loans and leases. So what is this telling us? Is the banks are trying to fill the hole in the bucket. So their loan programs are shrinking, which we'll get to, and they're trying to fill that hole with bonds. They're buying bonds, and they bought $30 billion of mortgage-backed securities in a week that everyone said bonds are dead. They're horrible, the worst investment in the world. No one wants to own those things. In fact, we can go look at, and now this is a U.S. Treasury securities, but we'll talk about that in a minute. Here's the week. This week, these 5 days, when everyone's selling, the banks bought $30 billion worth of mortgage-backed securities. Now, they also turned around and bought about $4 billion of U.S. Treasuries. And what's going on with that is it seems like the banks just are struggling to keep up with the demand of the Fed. So they're not increasing their mortgage or their treasury securities, but they're increasing their mortgage back. And that's great. As a long-term duration bond bull, I'm great. Buy mortgage-backed securities because guess what a lot of mortgages are? 30-year mortgages. Well, if the banks are buying 30-year mortgage bonds, guess what direction they're trying to get long rates to go? Down or up? If you pick down, you got it right. That's right. They're buying bonds to drive rates down. Now you say, well, Steve, some of this doesn't make sense. If banks are shrinking, right? Because that's the question is, why do banks want lower rates? Steve, if banks are shrinking, shouldn't they raise rates to get more deposits? All right, this is a faceplant kind of moment here. No. Okay, think about this. Is a deposit an asset or liability of a bank? Which is it? Asset or liability? It's a liability. So why do they want more deposits? Why do they want to pay people more interest on money that's sitting in the banks? They don't want that. No, they need more loans. The problem is their loan book is shrinking. So how do you get people to take their money away from the bank? Because look, let's just say rates went up a whole lot. What would people do? They deposit money in the bank to collect interest, because what do savers like? Collecting interest. So they like it. So they would do that. So banks don't want higher rates. They want people to get this money out of here, take it away, go somewhere else, do something else and borrow money. That's why they don't want higher rates is because loans are assets, deposits are liabilities. So how do you, right, if you were the bank, how would you get people to do something that you want them to do? If you want them to borrow money and get the money out of the bank that they have, would you raise rates? Or would you lower them? Which one's the sugar? The sugar is lower rates, right? Because savers then get disgruntled, pull their money out and go do something else with it. And then borrowers come and say, hey, rates are lower, I think I'll borrow. And that helps expand the bank's loan book. And you know this answer because it's telling you right here in bank credit. They're trying to fill that bucket that has holes in it, that Jeff Snider and Brent Johnson have posted on Twitter and in their writings many times. Because look at loans and leases at all bank credit. It dropped $24 billion, as I said. So the banks are filling this hole. And they're not being very effective at it. How about commercial industrial lending? That went down, where is that? There it is, by $11.5 billion. Residential real estate, remember, everybody's super bullish on the residential real estate market. It dropped $12 billion, despite all of these people, refi, buying homes, all that. Baffling to me, commercial real estate up $2.5 billion, and consumer lending down. Where is consumer lending? Down here, down $1 billion. So what is that telling you? There is no demand for loans at current rates, or there's an insufficient demand. You say, well, that's because banks are tightening lending standards. Do you blame them? Some people say, well, maybe they'll loosen it if Biden's president or the Congress could. Seriously, don't make this a two-faced palm show. Not going to go there. Why are banks not wanting to lend? I'll show you why. Because there's 21.5 million people on unemployment. Now, if you're lending money to somebody, what is the first thing that you want? You want to make sure you're going to get that back. Now, when there's 21.5 million people on unemployment, what are the chances there's going to be more? Probably pretty good, right? No stimulus, at least probably through the end of the year. Winter months are slow. More layoffs are likely coming. Challenger layoff announcements are still running pretty high. If you are a bank and you want to lend people with the knowledge that you're going to get your money back, do you going to feel real confident about giving someone a loan and find out maybe 3 months later, oh, by the way, I lost my job? What's the smarter move? Don't lend to them. Tighten lending standards. Make sure only the people that have the highest probability of keeping their job can get a loan. But what is the flip side of this? Because some of you are like, well, I thought you said the banks were going to crash the economy. You haven't done it. It will happen. In the macro world, sometimes things don't happen on schedule. They will happen. But they're going to keep lending standards tight. And they're showing us right here in this H.8 data that there's a problem. That they're having to fill in the holes of the bucket by buying Treasury securities to lower rates because the Fed won't do it. All right, let's move on to enough of that rant. Let's move on to the charts. Now, for those who like the Fred database, I noticed today that they changed this very exciting, the macro, they changed the color shading of a recession to this pale yellow. The M2 money supply, the growth rate, I know, you're right, Steve, you need to get a life. I know, I'm working on it. 12-month rate of change is 24.03% and falling. The 6-month rate of change is 7.05 and falling. 3-month rate of change is 3.21 and falling. Let's go look at the M2, and what do we find? Savings deposits down slightly. That's interesting. Demand deposits, where are they? Right, they're up slightly. So, 40, a little over 40 billion. So it looks like people are getting ready to pay bills, which kind of makes sense because this is the end of the month and then the 1st of November. So we're seeing the end of October for going into the 1st of November. And what happens at the end and the beginning of months, that's when people pay most of their bills. And hey, money flowed back into the market as institutional money funds. These are your money markets and your 401ks and IRAs and brokerage accounts. Money left money market, and well, where is it likely going? Into the stock market. So interesting there, but not a huge growth in the M2. Moving on to real estate loan growth, we can already guess this is down to 2.19 from a year ago. Despite record low interest rates, you have dangerously low real estate loan growth. This is how you know that the probability that there's going to be a housing crisis is coming, because it tells you when real estate loan growth contracts, you get housing crisis and you get lower housing prices. Why? Well, again, it's just simple stuff. How do you get people to go out and buy homes? Some of you watching the show, I know I've talked to you, or you send me emails. You're young, you're saving money, you want to buy a house, and what's the problem? Can't afford it, right? Price is too high, so you keep saving, wait. Well, how do you get people to go out and borrow money to buy homes? Do you do it with higher prices or lower? Yeah, lower, right? So you can see that happening right here. The 6-month rate of change is at minus 0.15% and falling. The 3-month rate of change is at minus 0.54% and falling, suggesting that we are going to see a negative year-over-year rate of growth at some time in the not too distant future. How about commercial industrial loans? Well, the growth rate just ticked down slightly to 14.13%, but the 6-month rate of change is just hard down, minus 11.86% and falling, telling us there's going to be a big move down in that year-over-year rate of change. The 3-month rate of change, it dropped some more down to 5.36. Look, why do I pull the 3-month rate of change numbers? It tells you where the year-over-year rate is going. It's going negative. How about loans and leases and all bank credit? Now we're going to pull, commercial. We're going to pull real estate. We're going to pull everything together. Commercial real estate, consumer lending, everything together. And it's down to 4.53% from a year ago, which is normally good. Except the 6-month rate changes at negative 4. The 3-month rate changes at minus 1.68. All are falling, telling us that we're headed into a recession, because when all loans and leases are contracting, it's interesting. Pale yellow here. Was this some special recession? Maybe I need to look that up. It tells you that bad things are coming. Look at consumer loans, credit card growth rate, right? This is how you know, is the economy recovering? What do consumers do? They charge and spend. Flat, or down actually slightly to 10.6% from a year ago. No sign of growth there either. I'm Steve Van Metre. Really appreciate you watching. I hope you enjoyed that interview with Jeff Snider. Be sure to like, be sure to tell everyone, tell all your friends, be sure to subscribe. On Monday, I plan on going through one of Jeff's recent reports as we look at how hedge funds are positioned, look at what all that's done to the bond market, and really all it's a testament to is the power of QE. I'm Steve Van Metre. I hope you have a great weekend, and I will see you, for those like the Sunday chart show, we'll see you on Sunday and then back on Monday to dig into the speculative position in the bond market, which is really what's keeping interest rates where they're at. When that gets unwound, yeah, you know it, interest rates, where's my arrow? They're headed, no, there it is, the red one, not the green one. They're headed down. Ooh, we'll look at that again on Monday. Thanks for watching. The content of this video is provided educational information only, designed to invite investors and other advice. It shows have to be construed as a recommendation or solicitation by a selling security, financial instrument, or participate in particular trading strategies. Videos prepared by Steve Van Metre. Personal capacity, opinions expressed in the video that do not affect the view of Atlas Financial Advisors Inc. or Steve Van Metre Financial.